All right, so we'll go ahead and get started. So today we're going to go over areas of interest, people call them points of interest, price delivery arrays, reference points, whatever you want to call it, whatever. It's all the same thing, and it's basically kind of like the first part to executing a trade. So we have our criteria, and then we have our execution. So with smart money, the biggest difference between smart money is you have kind of like a two-part entry model to a trade. A lot of other strategies, you just wait for two or three confluences to be happening at the same time, and then you just buy or sell. In smart money, you wait for an area for those confluences to happen. I think that's one of the biggest differences between price action trading and other styles is that it's a two-part setup. So not only are we needing multiple confluences such as liquidity being taken or structure switch shifting in our direction, but we also need that to happen in a certain area. So the main areas that we want to talk about today are going to be order blocks, and a lot of people rename these as supply zones or demand zones. And I've used that term before, so some of you guys are like, oh, you've said that. But really what it comes down to, it's much more beneficial to understand order block theory because it gives you a genuine, look under the hood at what's going on, and you're going to be able to execute more confidently whenever you're thinking from that perspective. And the next one I want to go over is breaker blocks. Some of you may have watched a video the other day that I put up about these. And then we have fair value gaps. Now, there are other points of interest in terms of, there's mitigation blocks, propulsion blocks, vacuum blocks. There's volume imbalances, which we're going to kind of go over all those in fair value gaps. And then balanced price ranges, which we just looked at a second ago, is an area where we have two fair value gaps, so to speak. So an example of a balanced price range would be something like this. So price move through on the offer and sell side and then rush through on the offer and buy side. So if price is still bullish, you should see a reaction somewhat like this right to the next area of liquidity, which a great example there. But these are the main three types of interest areas we're going to look at today. So the first one we're going to go over is order blocks. And some of this for you guys, you may already get this. That's fine if you do. But I'm sure that even if you do understand order blocks, you're going to be able to take something away from this. So we had a class recently that was called Redefining the Order Block that we talked about, using different criteria for order blocks. So first off, what is an order block? So the order block is the last move of manipulation before an expansion. And this is a very crude way to explain it. But I want you to just think of the order block like that. So whenever price is coming down, and we come into maybe an old area, maybe an area of liquidity, it's just a reference point, an area of interest, if you will. We come out and engulf. So this whole down move, usually the entire down move is going to be considered an order block. Now, on different time frames, it's going to look different. On the daily, it might be one candle. On the 4 hour, it might be 3 candles. On the 1 hour, it might be a bunch of candles. But the idea of an order block is just a big move down to manipulate traders in order to generate liquidity to then push price back up. So if smart money wants to get long, they're going to have to create sellers. So let's say they sell a ton through this leg down. And once price pushes back up, they bought the liquidity under here and all the liquidity generated from that leg in price. And once they buy, let's just say they have those positions that are short to just generate liquidity, and these are not intended to profit or generate profit, I should say. And then they get in the true move, which is the longs. So this is what you call institutions being net long, so to speak. So if the order block is indeed an order block, you don't want to see price whenever it returns to it. Let's say if they traded within this level, coming out after they bought up all the liquidity, in reality, it would look something like this. They'd have buys all throughout because an algorithm doing it. But once price pushes down, enough sellers are available. Those sellers are then utilized and smart money buys, and price expands rapidly. So if they are underwater on this position and price is moving rapidly up, and let's say this was targeting another area of liquidity up in this region. So once they hit their target on their buys, they're net long all the way up here. And they've made, quintuple the amount in longs on profits than they lost on shorts. And these shorts are just underwater now. This didn't really have a stop loss, so to speak. They just entered this trade in order to manipulate price down so then they could get in their real move. But banks are not in the business of losing money. So what's going to happen is mitigation. So a lot of people use that term and have no idea what it means. Mitigation means exactly that. They're going to mitigate their losses, right? So they don't want to lose money if they don't have to. This was just to manipulate traders. So once price comes back down into the order block, if it is a valid order block and the intention is still to go higher, you should see a rapid expansion away from it. Why? Because they're closing those shorts. So if large shorts are being closed, that is going to be the equivalent of a buy. And it's not like some guy sitting in a suit and tie doing all this. Of course, it's usually algorithmically manipulated. But once we see price move to this order block, if the bias is still bullish, we should see bullish structures signifying that there has been an influx of demand into the market. And that's where people get demand zones. But in all actuality, that's what an order block actually is. It's not, necessarily they're going to be buying in the same exact spots, which theoretically and technically they are, but it's more or less closing sells in those same exact spots. So if we know an order block is the full down move before we have an expansion, we're going to use that hold down range. We're not going to just use one candle unless you go up in time frames to where that becomes one candle. So for example, let's look right here at this order block. When price came, we went down, took out some internal liquidity. Is that one candle on the 1 hour? Looks a little different, right? What about the 4 hour? Looks different. So the ways you can do this is you could go in and say, okay, well, I'm going to use this whole range, because remember, the hold down move is what you're looking at as an order block. And a lot of people say, oh, well, it has to be one candle. And this is where people get confused, because price is fractal, so you're going to be seeing different perspectives through different time frames. So just because there was a move that had manipulation to the downside on a daily that was one candle, doesn't mean it's going to be one candle on other time frames. Now, order blocks don't necessarily have to immediately break structure, like a demand zone mapping. Why is that on my mouse? Keeps doing that. But demand zone mapping, you want to immediately break structure. But for instance, in this example, price comes down, takes out a low, we form an order block right here. Now, this is where you can be a little more aggressive once you understand bias, is because if you are bullish and you have already, established that, or we've already talked about market structure and liquidity, but you've already used liquidity and market structure to say we're likely going to a premium, because right here you have that short-term high shift, or if you use this right here, so that's telling you price is going up. So anytime we take out a low, you're looking at it as a buying opportunity. So we don't necessarily have to take structure before we look at that as a buying opportunity. So if we are in a bullish market and you're confident in that, and we have not met our liquidity targets, right, which would have been here, because we had equal highs and a premium, then every time we take out liquidity to the downside, we should be looking for reference points to get active in the market to go to the upside. And this is what comes with being confident in the direction that you're looking for, not looking at structure without context of liquidity, and not looking at liquidity without context of structure. So once we have established we're bullish, we look at any down close candle that gets engulfed as an order block. Now, how can we raise the probability that these order blocks will see a reaction? And that goes back to the class we had on redefining the order block. So a strategy that I've been using a lot, and it's extremely, extremely consistent, and it also works with finding reversals, is waiting for a candle that closes under liquidity. Now, does that have to be major liquidity, like external range liquidity? No. It can be any candle that is by definition a high or a low. So any candle that has a candle on either side of it that has two lower highs, if you're looking for a high, or any candle that has two lower or higher lows. So in this example, we have some internal structure right here. Price comes down and closes below it. Now, if you're not looking at price in the context of the range, in the context of structure and liquidity, you're going to look at this as a displacement breakdown, and you're going to look to short here. Right, and this is where basic, simple, smart, or supply and demand doesn't work that well, because you'll say, okay, well, price was at at this order block at equilibrium. We got to choke, and then what happens? You get blasted, and it's just simply not understanding ranges and not understanding that price still has a reason to go up. So instead of looking at that as a break of structure and trying to short this order block right here, you look at that as a buying opportunity, especially once it's been engulfed, and you can see price came back down into it, right? So, after price came back down into it, what would you have done then? Well, you can use structure to identify, is what I'm looking for happening. So then you look for bullish price action. So what is bullish price action? It's going to be lows getting taken out and immediate expansions, right? So for instance, what happens here? We're looking in this range. What's happening? We're seeing lows taken out. Short-term highs are taken. Price is consolidating. Lows taken out. All of that clapped. Pushes up. This is taken too, and we start to see this bullish price action. So that's going to help you be bullish on your bias. Now, it's not to say you're going to long every change of character and swing for the fences. ES is a tough beast to long, but in that example, you're looking at that order block as a reference point for bullish order flow, and once you start to see bullish order flow in the lower time frames inside that reference point, that's the two-step system to really getting a confident bias. So order blocks are going to be those last down pushes that get engulfed in a bullish market, or this goes the inverse for anybody who's asking for bearish examples. Usually I'm not one to give a bunch of examples on like a bullish side and a bearish side, because I want you guys to get familiar that it's the same thing, right? We're playing a numbers game. All numbers have an inverse, except 0, of course. But we are looking at it from the perspective not of a bull or a bear, but of what's going on in the market. So in order to do that effectively, you have to be able to flip your perspective very easily. So I want you to look at things that I'm going over in a bullish sense the same way you'd like having a bearish sense. So once price comes down and takes out that low and closes under it, that becomes a much higher value order block. Now this is a little bit more of an advanced strategy, and it may take some time getting used to. Sometimes it's easier to just trade order blocks before that have an imbalance. And that leads into the next type or confluence you can use an order block, is seeing an imbalance afterwards, right? So that really will show you that there is a strong displacement coming out of this down move. So that down move was definitely just manipulation. When we get that much of a shifted structure, we leave a fair value gap, price travels into it, engineering more liquidity, and then what happens? Take out the sell side into a price delivery array, which is this order block, expansion down into we take out the buy side up here, expansion down into the sell side. So after price takes sell side right here into a price delivery array, what do we look for? Especially when it's these clean equal highs. We're going to look for the buy side. So this is whenever you're combining your structural bias based on premium and discount, that we think price is going to go higher. Yes, we're in a bearish range, but we're looking for price to go higher. Why? Because the displacement's telling us higher. So we have these consolidations in a bullish market, and we get an expansion out of them, and we're bullish. This is when we look for power of 3. So just like we caught a power of 3 longs on Bitcoin, it's the same thing, right? We are looking for price to go higher because we're looking at this high. We saw a consolidation. Guess what we came down into? Right into this down candle, and there's actually a unicorn pattern, which I'll get into in a second. We're going to use this as an example. But I'm going to go back to yes. But when we're looking at price and the correct bias, we don't look at this as, oh, okay, it's distributing and we're going to go down to new lows. We look at it as it's distributing to go back down to reference points, to take out sell side, because we took buy side, then we take sell side into a reference point. This is what's very important. When you take sell side to a reference point, especially like an order block, this can be order block, fair value gap, breaker block, whatever, right? We take it out, and then price starts to give us that bullish order flow, and continuously we seek out liquidity. So one thing I want you to understand is that we build our bias based off of our structural reasoning and displacement. That's for me, that is the biggest part of bias. And obviously we're going to see what type of order flow is being respected. We're going to see what kind of liquidity is obvious, but structure is going to be paramount, and that's everything in price action trading. So, once we are looking at the market in the correct way, we're using areas of interest as stepping stones on how to get to where we think the market's going. So you formulate your bias, and then these areas of interest you just use in order to kind of find your path. So for instance, we see an order block, we traded an order block. What happens then? Price comes up, shifts up. What does it leave behind? Fair value gap, right? Then what happens? Price comes up, moves down, doesn't really give us much, but then what? Balanced price range. And you can see that price is consistently drawing towards something, and you're just looking at the stepping stones to get there. And once you tap a stepping stone and you get low time frame displacement up, you're bullish until you take out some kind of liquidity or you hit some other price delivery rate. So in this example, we tapped right here. And let's just say you were bullish from right here all the way to here. You looked for longs this day, you probably won. This day you won. This day you won. You lost here, won. Pretty good odds if you ask me. So once you develop a strong bias on the drawn liquidity, you're just looking at areas of interest as methods in order to get there. So the next one we're going to go over is fair value gap. And this is something that I really like using in the lower time frames and on the higher time frames as well, but I like using them for entry. So fair value gap, the best way to explain it is, I'm not going to try to get into like SIBI, BISI, and all this fucking overcomplicated shit. I'm just going to explain it in the way that's going to actually help you. And that is that once we see a very big push in the market is going to come down at some point and retrace that gap. So fair value gap is the distance or the gap between the previous candle's wick and the candle after's low. Now notice it's a 3-candle formation. A lot of people want to play a fair value gap when this third candle is forming. That's a no-no. You wait for that third candle to close because you don't know if that candle is going to wick down. You don't try to anticipate a fair value gap forming. So what we want to use fair value gaps with for the most part is an identifying displacement. So if we're looking at the market from a sense of trying to find the true direction of the market, let's just look at some examples over here. So for instance, let's say if the market does something like this and we leave fair value gaps, like yes, it left fair value gaps here, but this isn't going to be displacement. We want to use, I guess this would be a better way to put it. Fair value gaps are a way to identify institutional involvement. So you have to ask yourself, is that institutional involvement meant to be a rate on stops manipulation, or is it meant to be a continuation and a move that ensues after a rate on stops? So if we see fair value gaps and massive pushes down into an area of liquidity, but we then fail to close under that liquidity and start expanding up, we can assume that this push down is a manipulation move. Now I have to use that in context the higher time frame since we're on a 15-minute here, but if we see displacement down into a liquidity pool and then a sharp move out, we know that that's manipulation because this displacement helps us determine what true moves are, but they also help us, or it also helps us determine what is a move of manipulation. So number one, fair value gaps, you just want to make sure that they are identified. You're just looking at it like, okay, something happened here, so to speak, some kind of institution involvement. Now you want to use that with structure to see if that was, okay, was this a true move to the upside or was this just manipulation? So we're looking at displacement, we're looking at structure. Whenever we see clear moves to the upside, oops, wrong tool. We see clear moves to the upside like this, and price has a nice full-bodied close above it, we look at that as a displacement in the market. That leg right there can be our, we can look at that as a dealing range. So then we're going to look for areas of interest like fair value gaps or order blocks or breaker blocks down here into a discount. So in this example, we had a fair value gap at a discount. Right? Another example right here. Fair value gap into a discount. So whenever we are looking for these levels, whether it's order blocks or fair value gaps, and also this was a balanced price range. Now let's go and balance price ranges. It's literally just 2 fair value gaps that don't have wicks on it. So notice that this zone at this time had no wicks. So these are very high value. Always be mindful when looking for these. When you see a fair value gap, train yourself to always look to the left, see if there's another one, because those are going to be very reactive areas. And you treat them just like any other POI. Once price gets down into them, you wait for structural confirmation. So as price comes down into this, we see barely even comes below it, doesn't even close a candle under it. Rapid expansion up. So on a lower time frame, what does that look like? And we tried to actually long this, but it never came back down for us. But we see that price comes up, displacement, trades into the first fair value gap, and then off to the races. So, we look for this kind of move, and then more areas of interest on a lower time frame happening inside the higher time frame areas of interest to end up framing trades from. So when we're looking at the market and we're looking for these areas of interest, we're going to be focusing on not just one kind for our bias, but we're going to be watching all of them. Now, I recommend for people who are just starting out and learning some of these, don't try to enter off every single one because it will lead to over trading. Don't be on the 1 minute entering every single 1 minute order block or fair value gap. But I think that it can be very beneficial to start getting used to on a bias scale, because then, once you're getting a little more comfortable, you're going to be able to use them more efficiently as an entry tool. So next, let's go over breaker blocks. So let me find this example. There was a really good example I used for that video. Can't remember exactly where it was. I want to find it though, because it's a great example. Oh, it's right here. So that's where we actually were. This is a really good bit of price action. So a breaker block is, a lot of people overcomplicate these, and it's funny to watch a lot of these newer like gurus that haven't even watched like old ICT. And whenever we're looking at breaker block, a lot of people, like, I've heard crazy ass explanations, but really what it is it's the last candle that forms a short-term level of structure before that price trades into an area of interest. So example, we've got an order block. So this is going to be putting a lot of things together. So we've got an order block right here. We're going to just consider this whole down move because I don't think it barely touched this right here. Right? So price, we'll just draw this whole range out because it's important you use structure. And when I say structure, I'm talking about ranges, premium and discount. That's all structure to me. So in this area, where is going to be areas of liquidity at a discount? Right here, technically this is at a discount. We can mark all these if you'd like, but if we pick here, here, or here, where has the most liquidity? Right there. So when we're looking at price that takes liquidity into an area of interest, there's almost always going to be a breaker. So when we see, and this goes hand in hand with market maker models. So this in itself is a market maker model. It's very ugly, but it is, because a market maker model is a original consolidation, a run to support, aka liquidity, and then a smart money reversal, right? Now, not all of them are going to be pretty, and not all of them are going to be very easy to catch, but that concept is what a market maker model is. So once we get that run to support, and we get turn that off. I don't know why it's still doing that. There we go. So once we get a run to liquidity, or run to support, and we pivot, we take out that liquidity into a reference point. And that reference point can be an order block, it could be a breaker block, it could be any other ones, it could even be a liquidity pool. Now, that pivot, that last run to support or run to resistance, if we're talking about a bearish model, that is going to be where your breaker's found. So a lot of people will only mark the last candle before, like a lot of people would mark this candle down here, and I'm sure there was low time frame breakers in this area. But if we're talking about this time frame, we're looking for the last candle that made the structure. So for instance, if we're looking for a bullish breaker, we're going to look for, trying to think of like a failed order block. I hate using that logic because that's not what it is, but just that'll help you remember, because you're not going to look for a down close candle like you would a bullish order block. You're going to look for a bearish order block type deal, an up close candle. And you want this up close candle to be the last up close candle before the short-term high that was formed before the liquidity was taken. So this is a very good example because it's very specific. So look, a lot of people are like, why isn't this the breaker? Because here's the last short-term high. No, the liquidity was taken here. So what is the last up candle before the short-term high was formed? That right there. So that would be your breaker block, and after price engulfs through it, which was here, that was when it was activated, so to speak, and you see the reaction got it. Now, breaker blocks are definitely the toughest to use out of anything we're talking about today, by far, because of it is a little more complex. Now, the ideology behind a breaker block It's funny as fuck because people talk about this shit. I've seen like people talk about it on YouTube videos, and it literally in the old ICT. All it is people who are looking to short right here, right, for whatever their plan was. When the market goes back above them, they're underwater. So when the market comes back down to their entry, they'll close it. That's the whole ideology between a breaker. And it's funny because when you really think about it, it's pretty much a break and a retest. Some people are going to get triggered by that, but that's basically what it is. But you want to use it in context of liquidity, in context of your structure, in context of trading into a price delivery rate. So the only time I recommend using breakers, and this may be an unpopular opinion, this is just my experience with them, is whenever the market is trending heavily. So what that means is, okay, if we're bullish and we've came down to a very deep discount just like this, and we've cleared out all internal liquidity, we have nothing, no reason to go down. We have only reasons to go up. Right? You've got a very clear draw on liquidity. Your bias is clear. You came down and swept all internal liquidity, and you saw a massive expansion. That's when you use breakers. Now you can use this on a lower time frame too. I think they work almost better on the lower time frames, but you know, it can be a little tougher to use them. But I recommend whatever you use breakers, test it first, because it in my opinion, for me, it was the hardest reference point to learn, because I would always pick the wrong ones. Like I would have picked this at one time. I would have picked this candle or maybe this candle. You're like, what the fuck? That's just not how it works. So another great example of a breaker would be the AVAX trade we took. Great example. So on a 4-hour, look, we took liquidity into a higher time frame reference point. So we have this order block right here, this candle, and this order block right here. So this is both examples. So you don't necessarily need to know which one, but we know that we have this close down, right? Price traded into a higher time frame order block right there in the daily. Also, if you want to use this, you know, last candle before up move, it's this right here. But either way, it traded into a price over array. So we hop in the 4-hour and see, okay, well, where did price, or where was the breaker here? Because we know that we have somewhat of a market maker sell or buy model here. And we have an original consolidation, a run to support, smart money reversal, expansion. Here was our accumulation, and now we're pricing our reaccumulation here. But we're going to look for breakers in that run to support leg of market maker model. So price came down, we consolidated, took out liquidity into a price over array, engulfed, and then you can see that obviously it was a valid level because we hit it. The level in the breaker is 18.475. You can look up at the top left of the screen. We tapped 18.475. So we know that that level is valid. So there's another example of using it. And I hope that it helps to see that. It's good that we're talking about this today because, you know, I can show you guys theory and hindsight all the time, like most people do. But whenever you see it used live, I think it helps you guys retain it a little bit better. Yeah, so the gist of what we talked about, there's one more I wanted to go over. That's volume imbalances. Yeah, Joel, that was crazy. It really was. So volume imbalances are going to be just gaps between candles. And I know ICT's been pushing the new week opening gap, the previous week opening gap. That I think that they definitely work. They're basically just like a high value volume imbalance, but they help a lot. Like for instance, like here's a volume imbalance. Here's a volume imbalance. Here's a volume imbalance. They're basically just gaps. People in the stock market have been trading these for a long time. It's not like ICT created this, it's just a different name. But gaps like to be refilled. Just kind of instill that in your brain. Gaps like to be refilled. I've been testing using them with fair value gaps as a balanced price range. They're not as consistent as just using fair value gaps, but I have tested them. Keep in mind, but I recommend if you're going to pay attention to them, they work best on higher time frames for indices, and definitely pay attention most to the weekly opening gaps or like a new day's opening gap. Like those, you know, on a 1 hour, 4 hour, this is the same thing, but I would pay attention to the one between Friday and Monday, like this one right here, example, or for example. Price likes to refill those. So like for instance, if you see a new week opening gap, and you have a bearish power of 3, right? So we have a consolidation, push up, or you put the high of the weekend on Tuesday. You will see most likely price return to that opening gap. So like for instance, if you're bearish on the week and you see what you think is the high of the week on Tuesday or Wednesday, you can look for that gap as an easy draw on liquidity and look for areas near it like that as your draw. So a little bit of a quicker class today, but I don't want to just beat on a dead horse. That is the gist of it. A lot of super valuable information in this class. If you guys have any questions, go ahead and ring them off. But I don't want to, just kind of go on. I want to make sure that that we're staying on task and you guys are getting the most value. Zap, the recorded video will be on the playlist that's pinned in lessons. That's where they all go. Right. Cash. Oh, hell yeah. Appreciate that, Haas. Appreciate it, man, for real. To show an example of when I would use a lower time frame breaker for entry. So let's see if I can find one. So one thing when I do about breakers, when I use them for an entry, here's a great example actually. So whenever you're pretty confident the market is going to be going down, like we're in this massive down leg already. Let me use a rewind tool. So price has made a big push down. Actually, it's funny, on stream, I remember I kind of like psyched myself out because I was like, oh, this looks like displacement. This looks like a liquidity rate. This was literally the other day. But it's pretty obvious looking at it in hindsight that the market was pushing down, right? It had a nice fat push under this low. So once we come to a premium, the market's in a very viciously downtrending market relative to this time frame. So this is where I would be looking for breaker entries. Once we get an entry, you don't have to wait for like necessarily the highest high in order to trade. Now, as far as stop loss usage, I don't like using breakers for stop losses that much. It's just, in my experience, it doesn't, the extra risk reward usually will kind of be outweighed by it's too many losses. But in this example, we had a nice time right around 2:30 p.m. So we took out lunch liquidity, displacement down. So in this example, when the market, we're kind of waiting for the market to dump down. We had this big push down. It's just like trying to get in the market at this point. So you could have used a breaker in this example. So what I would have used is kind of like this whole range. Now, 1 minute, and this one, you wouldn't have tapped the breaker that I would look for, which would have been right here. Actually, this kind of goes into something else that I did want to go into. The unicorn pattern, we'll talk about Bitcoin, but if you see a breaker with a fair value gap inside of it, I'll still use the fair value gap. So that, but I look at it, that's what ICT calls a unicorn pattern. So a breaker with a fair value gap would be, I guess, what I would use on a lower time frame, but it's still, you're really just using the fair value gap. You're just using the breaker as an added confluence. So the Bitcoin example, I'm glad I actually looked at that because I would have forgot. So we look over here. We had a breaker right here, so we came down, took liquidity into point of interest. So we had this breaker with a fair value gap inside of it, right? So that's where I will look for that kind of price action, and it's kind of an added confluence. But really, to answer the question in short, I would use it whenever the market is trending really rough and like you're very confident in the bias. And even then, I would use the stop loss above a fair value gap or a swing high. I don't really like using, but some people use them with stops under the breaker, and it will work in certain examples for sure. But in my experience, I've done better using a stop just above the high, because I'm all about just, if you're 2 to 3 hour in a day trade is not bad. It's very good in my opinion. If you're actually getting on a cash account, and it's there's a lot of like 50 hours. It's like, here's the thing with me. It's like, okay, well, if you're truly getting that consistently, you're a multi-millionaire, billionaire. If you're getting 30, 40 hour a day, like, this is why it's like hilarious to me. Like, so like interest rate. Which one is it? I think it's this one. No, it's compound. No, it's compounded. Just go. I see people on Twitter. It's like 50R. It's like, bro, like, you're literally a trillionaire at that point. So like, let's say if you have a $1,000 account, right? Say you're getting 30R weekly, because people be saying they get shit like that. So let's say you do that for 1 year. Yeah, okay. Like, you have 21 M's. Like, I mean, hell, if you're doing it, more power to you. But, and that's up $1,000. People be saying they do that like at 200. It's like, bro, what? Anyways, getting using a stop loss that's a little farther away on a on like a 1 hour, or I'm sorry, not a 1 hour, on like a 1 minute chart to get 3R or 2R instead of getting like 10R. In my experience, that's what's gonna make you more money in the long run, because you're gonna be much more consistent. But on that note, guys, I'm gonna hop off here. I appreciate you all as always for coming through. We'll be on here on Tuesday again, and interested to see how crypto does this upcoming week. Definitely paying attention to crypto moving into the week. But I will see you guys later. Peace.